Nat gas may have ended higher today, but it is down 13% this week, hitting lows not seen since June of 2020. So is more weakness coming down the pipeline? Well, joining us now is Bill Perkins from Skylar Capital Management. Bill, it's great to have you back on the show.
Great to be back.
All right. So we've had really warm weather this winter. And just in terms of the seasonality here, you have a March-April spread that gets traded. It is known as the Widowmaker trade. Walk me through what we're seeing right now, how unusual it is and how it sets us up for the rest of the year.
Yeah, it's pretty unusual. It's been 73 years since we've had this type of warmth. And so naturally, the market has fallen in order to induce demand so that we can burn a little bit more gas and try and make a dent on the overhang. But it's been so warm, we have to even go lower, and we're facing the prospect of shut-ins. So March, April is negative. Significantly negative, and the curve is very, very contango, very steep, playing into people's fears of congestion even early in this season.
So what would it actually take for us to see shut-ins? And I ask that knowing that in some cases, nat gas is a byproduct of pulling crude oil out of the ground, and you have that priced at $80, and those production levels at record highs here.
Yeah, so it depends on what region. In the Northeast, it's between right around 75 cents. Around the hub in Texas, $1.10, $1.25. It really depends on transport and what's going on in storage. But producers are definitely slowing their roll. They're dropping some rigs. They're delaying completions. They need to get past the injection season. They need to get to the winter in 2025, where things start to look much more bullish. We have a lot more demand coming on from exports and power demand growth.
So, Bill, how are you trading this then? Are you just staying away from nat gas?
I try and stay away, but I can't. I have two conflicting opinions. One is that there is significant risk for needing shut-ins and the price going much lower. But we've gone so far down that we have enough gas burns that the actual amount of gas on a daily basis going into storage is a lot less. And so spreads seem wide. And I'm trying to reconcile those two views. So I'm looking at playing it via options and spreads.
Okay, and what about the rest of the energy trade, given that the U.S. economy is holding up so well?
I mean, the total energy picture looks good on a multi-year basis. Next year, the following year, particularly for natural gas, because we have about 10 gigawatts of coal retiring a year or more. We have 1.6% electricity load growth from data centers and just the reindustrialization of America. That's heavily falling on natural gas and a little bit on renewables. And so gas demand looks robust domestically, and it also looks robust internationally as people look to get off coal and move to natural gas. And so, the outer years look great. It's just the intermediate period looks pretty bad and scary.
Yeah, and of course, policy will play a big role in this, too, when you have an administration that's been freezing some approvals of the LNG exports and then a House that's fighting that are members of Congress that are looking to counter that. In the meantime, though, I completely forgot what I was going to say. Okay.
I mean, we can talk the power situation. The power situation is very interesting with the administration right now and natural gas. You have all these incentives for infrastructure, where it be tax and battery, et cetera. But on the other hand, the administration makes it almost impossible to permit anything in any reasonable amount of time. And so I think that the regional grid is in trouble in the next 2 years, not natural gas, but power. And I think that certain states are going to look like third world nations with their power prices, given the fact that the infrastructure is not coming in time to match the growth and the demand.